Hi there everyone. In this video we discuss interest rates and inflation. I know we've discussed it for the last several months and we're going to keep doing just that. We're also going to talk about the slowdown in China, and we're finally going to talk about earnings and dividends for the Australian market. So welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 30th of August, and before I get into it, you do need to be aware that anything I say is only general advice. So it doesn't consider your personal financial circumstances, and you have to decide if it's appropriate for you. So CPI and interest rates. You're probably tired of hearing me talk about it every week for what seems like forever, but it really is the main thing driving our market at the moment, and indeed global markets. And that's been the case since pretty much the start of 2022. So markets have really come off as interest rates have rallied, and we've basically seen markets fall for most of 2022, and then they did tick up a bit in 2023 on the belief that interest rates were nearing a peak. Now, across the start of August, this belief was challenged quite a bit by the continued strength in US economic data. US data pointed to a really strong economy over there, not an indication that inflation was going to come down, and as a result, US bond markets started to price in more interest rate rises. Now, obviously we're not the US market, but our own market sort of followed suit a bit there, and we did start to price in more rate rises ourselves. And indeed, we saw Australian government bond yields tick up to pretty much their resistance levels, their multi-year highs, the same level as October last year. And we saw them reach that about a week ago now. Now, over the past few days, things have changed in that regard. So late last week, we saw the Federal Reserve meet at their Jackson Hole Policy Symposium, their yearly policy discussions. And the Federal Reserve speeches there were seen as indicating that they'd continue to hold on rates. Now, I kind of disagreed with that opinion by the market. And the reason for that is their speeches basically said that if data was going to continue to come in as it has been, that they were going to lift rates. So I didn't really see the hold narrative that the market seized upon from that meeting. But it could be the fact that stock markets have been falling in the lead up, bond yields have been rising in the lead up, and that basically the market had reached a sort of turning point just from the fact that prices have moved so much. After this, and in fact overnight, we actually saw some fairly, I wouldn't say deflationary, but worse than expected US economic data. So consumer confidence was lower than expected, job openings were lower than expected, and that was basically the signal to the market that maybe they will hold on rates, maybe we are near an interest rate peak. And US markets seized on that overnight, they jumped very strongly. Our own market opened quite strongly this morning based on the US session, but then we had a pretty sort of golden egg for the market, and that was the Australian monthly CPI indicator coming in lower than expected for July. So year-on-year inflation to July came in at 4.9%. That was versus about 5.2% expected, so it came way down below what was expected, and it was down from about 5.4% in June. So prices are still growing at 4.9% per year, well above the target rate, but it is starting to come down according to the official data. And that is really what our stock market wanted to see. So that was the message to the market to shoot higher. And we went from about 72.60 on our XGO up to 7,300 roughly. So a huge additional jump after that data came out. Yes, there were a lot of positives. Yes, it's good that inflation is slowing. However, some things remain sticky. And these include energy prices, power prices, insurance premiums, and a few other things that remained quite sticky and that the RBA will want to see be lowered with everything else. But all in all, it was a very positive read for the market, a sign that the battle with inflation is starting to progress. I wouldn't say be won, but is starting to the RBA is starting to strike back, let's say, and things are starting to head in the right direction. So with this lower than expected CPI locally, what does that mean for the RBA? Well, they will meet next Tuesday. It's not too far away now. And it was a pretty line ball decision, but after today's announcement, after today's data, I should think they'll probably hold at this next meeting. So I think we're likely to see interest rates unchanged at the next meeting. And that's probably the main reason why our market jumped so strongly today. Now that doesn't mean that we're at peak rates yet, or that we're at peak rates at the moment, and all it takes is one bad bit of data for things to start going out of whack again. We saw oil rally quite a lot in July and August. That could be a negative driver of inflation again as we go to the next few CPI readings. So we will keep an eye on it, and I wouldn't get too ahead of ourselves in predicting a rate peak, but it does look like at least that we're very close to the end. And that was great for our market today. I also want to touch on the China slowdown, the slowdown of the Chinese economy. And really it's been bad for a few reasons. It's been bad because, it's traditionally the sectors of growth in China that have really felt the brunt of the slowdown. And this is, the construction sector, the housing sector, and yet, these sectors are part of the cause of the slowdown this time around, and particularly debt issues in those sectors. So we've seen the Evergrande construction company, development company finally collapse into bankruptcy, and we've seen a few similarly, or in some cases larger construction companies face real issues about their going concern. So the Chinese economic slowdown is happening because of a slowdown in these sectors, and those slowdowns are in large part related to just the extreme amounts of debt involved in some of these companies, and also just in the Chinese development space in general. Now historically, the lever that the CCP has pulled in response to these slowdowns has been to cut lending rates and encourage borrowing, encourage people to take on more debt. However, with this time around, these issues have been debt related. So by pulling that same lever, they risk worsening these issues moving forwards. And so that's caused a lot of concern for investors, because we can't be so confident that the stimulus response is going to occur this time around. Some economists are even saying that we might see a recession in China. I think it's very, very early to say, but it definitely seems like there is definitely a slowdown in the Chinese economy, and as them being our biggest export partner, that's not great for the Australian market. So we did see a lot of the material stocks come off for most of August. They certainly have bounced back a bit over the last few days. And part of the bounce back is that materials prices have actually held up really well. And then this morning we actually saw some additional stimulus announced by the Chinese government in the form of, again, cutting some lending rates, cutting rates on mortgages and things like that. And yeah, definitely it's good in the short term, bit of a sugar hit. But like I said before, these were some of the levers that created some issues in the past. So we will have to sort of keep a close eye on it, make sure that we're not seeing further debt-related issues come because of this. We definitely want to keep a very close eye on materials prices. There have been some guarantees from the Chinese government guaranteeing demand for some steel smelters, which is great for the iron ore stocks, and that has helped them rebound over the past fortnight. But it's definitely an ongoing story, and nothing you want to sort of say is over just yet. Finally, we've got the reporting season ongoing here in Australia. It's almost complete, and many of these stocks are now paying dividends or will soon pay dividends. Overall, it's been a fairly reasonable reporting season. I wouldn't say it's been great, but I would say a lot of things have been broadly in line with expectations. The thing is that it's been such a volatile market this year here in Australia. There hasn't been a whole lot of uptrending, a whole lot of upwards movement consistently, that all it needed to be was a reasonable earnings season. And encouragingly, profits and dividends have held up really well despite the volatility and uncertainty that we've seen. So I wouldn't say it's been too fantastic. A lot of the large stocks basically reported as expected, but it certainly hasn't been signs of an impending economic collapse here in Australia. So like I said, there's plenty of dividends still to come, including some of the largest stocks in our market. If you are in a trade or if you're considering a trade, definitely check the calendar for that stock, see if there's a dividend or see if there's a report. There are still a couple more, and consider how that may affect your trade. So let's have a quick look at the charts now and do some technical analysis. And this is the Australian market, and you can draw a very, very shallow, rough uptrend line from October last year. You may recall that I did say that our bond yields peaked last week, and they peaked at the same level that they peaked in October last year. So yields peaked here, and yields may have peaked about a week ago here as well. There was also a peak in July, which coincided with our trough back then. So gradual uptrend, let's say, and yeah, over the last week we seem to have found some support at 7,100 index points for the XJO. We jumped up quite strongly yesterday, and we actually crested or rose through some potential resistance at 7,200. Now this morning, with the strong US session, we opened up around the moving averages, but then when that CPI data came out, we shot higher. We shot back above the 7,300 resistance, but we ended up closing right on it. We fell back to close right on it. So we're at a key level of resistance. If we do go any higher, we'd be looking at the 7,360 level, let's say, and then if that breaks, the 7,470. However, I wouldn't say it's a clear break of 7,300 today. If we do see some overnight US selling, we could easily come back to, these moving averages here at 7,240. Generally, though, the movement is higher at the moment, stochastic pointing higher, and the momentum seems to be to the upside. Looking at the US markets, this is the S&P 500. They've also had a bit of a downwards move for most of August, and then they've started to come up over the past few days. Their strength, like I say, coincides with the Jackson Hole Symposium late last week. Everyone interpreted that to signal a hold. I think that was a very generous interpretation of the statements, but regardless, their markets pushed higher. And then overnight, with the weaker than expected job openings data, the lower than expected consumer confidence, their market shot through the 44.50 resistance level. They've pushed back up a bit, but the next level's not too far away. For me, I'd put it at 45.25, and that's really, one session of movement away. If they do pull back from here, that 44.50 level will probably now act as support, because overall, again, their momentum seems to have shifted to the upside. So that's it for this week, guys. Perhaps some optimism in markets due to the fact that inflation might be starting to come down, but there's still some uncertainty with issues in China, and the overall level of inflation is still extremely high. Hopefully you guys enjoyed this video. If you did, please click the subscribe button. It definitely helps the channel out a lot. And otherwise, I'll see you in the next one. Bye for now.